As some of the market's hottest groups take a well-deserved breather, and we find ourselves with more signs of a weakening economy, this might be a good time to own some slowdown stocks. Stocks of companies that will do just fine, even if we descend to very low growth as the Fed battles inflation to the finish line. Notice I didn't say recession, because that's what people who scare you into making the wrong moves will do. I'm not trying to do that. I'm explaining where we are right now, what the zeitgeist is. And that's why tonight I want to circle back to an old Mad Money favorite theme that we had put onto the shelf for a while, frankly, and that's the humanization of pets. For years, people seem to spend ever more money on their cats and dogs, something that went into overdrive during the pandemic. But, once the pandemic subsided in the post-COVID era, pet adoptions have slowed dramatically, and elevated pet food prices seem to be one of the first items that got inflation-related pushback. Now, though, I think the post-COVID drought is over. And I like the group again. So let's say if you agree with me or you have pets and you want to try to profit off of the thesis, I'm going to give you one retail play, one veterinary play, and one pet food play that I think work right here, right now. First up is Chewy. Yes, the online store for pet food, pet toys, pet healthcare products, you name it. The stock's caught fire here, and it makes me think that the pet food thesis is back. After roaring during the pandemic, Chewy peaked at $120 in early 2021, and then its growth rate shrank dramatically, and the stock got obliterated, plunging to $14 and change at its lows just 2 months ago. 2 months ago. That's an 88% decline from peak to trough. They usually don't go that much lower unless they're insolvent, and this one isn't. Since then, it's on the move, rebounding just under $30, including a monster move today as the e-commerce cohort came roaring back. I didn't see it coming. I wanted to do this. Wish I'd done this piece yesterday. I'm very sorry. At this point, despite this rally, I think the stock's still interesting, though. This one first came back on my radar when I spoke to Sumit Singh. He's the CEO. It was in December, alongside Chewy's first ever investor day, and it went well. Obviously, the stock wasn't done going down at that point, but I came away feeling impressed by how much the company had matured. Singh pointed out that they get well over 70% of their sales from dependable, recurring auto ship subscription plans. I happen to love the subscription business because it's renewable. It doesn't just fall off a cliff. In other words, Chewy's a lot more reliable than you might expect. I told you at that time, I thought Singh sounded strong and confident. And if you could buy it around $20, you could do well. Sure enough, when the company reported late last month, it delivered a monster earnings beat with a 55% growth year over year, even if its sales were only up 3.1%. On the conference call, management talked about green shoots in new pet ownership for the first time since 2022 and a less promotional environment, which helped boost profitability. In response, the stock jumped 27% the next day. And even though much of that was short covering, Chewy kept running and running and running. As I said, it just closed right below 30. For me, this quarter was indeed a game changer because the earnings are so good. You can make a legitimate case for Chewy's valuation even up here right now. See, the stock's selling for almost 34 times this year's earnings estimates, which sounds expensive, but listen to me. They turn in a couple more earnings beats like the one they just did, those estimates will turn out to be way too low. But even if the estimates are right, Wall Street's looking for 29% earnings growth from Chewy this year, and it's 34 times earnings. It's perfectly reasonable to pay this price for this growth rate. Next, there's Elanco. Oh, man, this is one tempting fate when you talk about this one. This is an animal health company that was spun out of Eli Lilly roughly 6 years ago. Lilly looks like it made the right move. We saw what the rest of Lilly did. Elanco makes treatments for both companion animals and livestock. Just like Chewy, the stock peaked in 2021 and spent the next couple of years going through the meat grinder. It fell 79% from peak to trough before finally finding its floor last summer, although it was that kind of floor. Since then, Elanco's more than doubled from those lows. When we spoke to CEO Jeff Simmons earlier this year, he was really optimistic. He explained that they've got 6 potential blockbuster veterinary treatments in the pipeline that are set to come out in the next 2 years. That includes a monoclonal antibody drug for parvovirus. Sorry, I don't know how to pronounce that. But fortunately, our dogs don't have it. It's usually lethal if left untreated. I don't want my dogs to get it. He's also got a pill for cats with diabetes. Big improvement, by the way, over the previous standard carrier, which is 2 insulin shots a day. I used to have 6 cats at one time. You try to stick a syringe into a cat, I can tell you, you're taking your life into your hands. Now, just after we last had Simmons on the show, Elanco was targeted by a sharp activist investor, Ancora Holding, wanted a major shakeup, including a new CEO. Management ultimately made a deal with Simmons keeping his job, but Ancora getting 2 board seats. I like that situation. I mean, look at it. Helpful, hopefully helpful, smart activist in there. Feet to the fire. And hey, Elanco's reported excellent numbers in early May. This was a clean, beat and raised quarter. No real hair on it, sending the stock up nearly 25% in a single session. It's continued to turn higher since. It should. But even after this move, Elanco only trades at 19 times earnings. Not expensive by any stretch of the imagination. Plus, the good news keeps rolling in here. Get this. I love this one. The company got FDA approval for a type of cattle feed that basically makes cows less flatulent. Huge. Hey, come on. Stop joking. Listen, it's actually huge for the environment because cows release so much methane, something that some urgency under the current president will no doubt, some agency will no doubt say, hey, listen, we got to make every cow take this. Not that they would know the difference. It's so stupid. No, I didn't mean that. I happen to own 2 cows, and they're dumb as plywood, though. Elanco will... All right. They're not that bright. Let's leave it at that. I feel bad for them now. Elanco, they don't watch. Elanco will launch next quarter, and I think it's a potential blockbuster. I'm telling you, my cow's going to take that methane pill immediately. So if you haven't been keeping up with this one, it's worth another look. Finally, there's J.M. Smucker, which does not have a methane pill. It's primarily known as a packaged foods play, with way too much snack exposure after last year's ill-timed Hostess acquisition. The stock got crushed last fall and hasn't really recovered, especially because everyone's so worried about the GLP-1 weight loss drugs. In fact, Smucker was making new lows as recently as a month ago. However, this company's also got a major pet food business, one that has been intentionally rationalizing recently, selling a bunch of non-core brands to Post for $1.2 billion last year. Good riddance. As a result, Smucker's left with a much smaller pet food division that's all about big-name brands. Milk-Bone, Pupperoni. I once ate a Pupperoni on the set in the show's first year, and I got sick, and we had to stop doing the show for half hours. I threw up, and now I'm back. Meow Mix, too. And this streamlined pet food operation feels like a much better business. In Smucker's most recent quarter, the pet food sales grew by 11% when you back out the impact of the brands they sold to Post. Meanwhile, their pet food profit margins soared. So if you want a pet food play, maybe hold your nose and buy Smucker. Do not eat the Pupperoni. Betting it can offset the expected weakness in snacks. I wish I'd give you a pure play here, but Fresh Pets had an insane rally. That's way too high. Every other major pet food brand belongs to another one of these big packaged food companies, a conglomerate, General Mills, Colgate, Nestle. I'm going with Smucker because of the distinctive shrink-to-grow, more profitably lucrative narrative in pet food. Plus, I think this is a good moment to own a defensive consumer packaged goods name because the market's gotten a little more difficult. Smucker's currently coming off a solid quarter, even as the stock remains near its 52-week low. By the way, while everybody's so worried about the snack division, Smucker's slimmed-down pet food business just did $452 million in sales. Hey, that's sweet-baked snacks. They only did $337 million. Those pet food margins are substantially higher, too. Should be more of a needle mover going forward. So here's the bottom line. In a tougher market, we need secular trends that can triumph in any economy, which is why I am circling Indeed back after absence for a long time to the pet trade. Chewy and Elanco are already on fire, but if you want a less direct pet food play, I'm feeling darn right optimistic about J.M. Smucker. And again, stay away from the methane pills unless you're a cow. Let's go to Reg in Georgia. Reg.
Hey, Jim. Great to be with you today.
Thank you, Reg. What's going on?
I've owned PepsiCo since it was Lay's potato chips in Atlanta. It's a great stock, and I know you like it. But it's been down lately. It's down about 14% from its high. The last few days it's gone up, which is good. But I want to ask the expert what's going on with that stock.
Okay, I think if you look at the relative performance between PepsiCo and Coca-Cola, it says everything you need to know. Coca-Cola is up 8% this year. Okay, let's just figure this out. This is really important. And PepsiCo is down 1.5%. Why is that? Because of what you mentioned. The aforementioned Frito-Lay division is viewed as being something that's going to be in the crosshairs of the GLP-1 drugs. I think they're right. Which is why I think right now that Coca-Cola is a better buy than PepsiCo, even after this differential. Mike in Texas. Mike.
Professor Cramer, good to talk to you again. How you been?
I am good. How about you, Michael?
I'm doing great, man. The sun is shining. Summer's full swing. We are talking about Costco today. Now, Costco is a core holding in my portfolio. I've been really bullish on the stock. It's been on an absolute tear. But over the last week, it kind of pulled back a little bit, and I wanted to get your take on this. Is this a short-term pullback, and I should be looking for an entry point to add to my position? Is there something fundamental going on here, and I should think about
No. It's bad. First of all, Mike, thank you for your conviction in calling me this. But let me tell you something. You know, I do a lot of work, obviously, with Jeff Marks, my partner with the Travel Trust, and this stock dropped 100 points, and no one even knew the difference. And you had to be buying. And I think that what we're always doing is we're always looking for a discount to buy Costco. That's the way I've been for the last 20 years. I'm not changing now. When the stock goes down, you buy COST. All right, look, the pet trade can work in almost any economy. And that's why I think it might be time to take Chewy, which has moved up a lot, Elanco, which is still reasonable, and J.M. Smucker, which is really down, out of the doghouse and into the house. Much more Mad Money ahead, including my exclusive with Okta. With holes being poked in the Microsoft cybersecurity story, I'm hearing what Okta makes of its biggest competitor when I sit down with the CEO. Then, as I was getting ready for the Thursday monthly meeting for the investing club that I just mentioned with Jeff Marks, I noticed one important theme when it comes to investing in multinational corporations. I'll reveal what it is and how you should handle these investments. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.